All right, everybody, I got to do it. I haven't talked a lot about these income annuities, and in general, I haven't been a huge fan of them, and finding reasons to utilize them has been difficult through these very low interest rate periods. But as most of you know, interest rates have risen. And finally, a product that I kind of like. They simplified it enough. They undinner seminared it enough. And the math actually kind of makes sense in a lot of different scenarios. So let's talk about this concept of guaranteed income. There are three choices out there. An immediate annuity is very simple. It's what most people's pensions are. The company takes a lump sum of money, hands it to an insurance company. An insurance company calculates how many years they think you have left of life. They calculate how much they can pay you based on that lump sum, and they guarantee that payment for life. You live longer, you win. You live less, they win. An immediate annuity essentially does not have any cash value. Okay, so there are some fun little options with that, but it's monthly payment for life in return for a lump sum that typically and historically is always going to give you the absolute biggest bang for the buck, right? If you're going to put a lump sum in, this is going to pay you more than any other product on the market, all right? Now, there's deferred income annuities, okay? Deferred income annuities mean I don't need income now, but I'm proactively planning for my future, and I know I will need more income in that future. And so variable annuities, most variable annuities come with income riders, and the income rider is just this special little guaranteed benefit that has lots of sales gimmicks on it. It has bonuses, it has locking in the highest your portfolio ever gets. It has guaranteed minimum growth, all these fancy dinner seminar things that they do to get you hooked in. Okay, national average in fees, 3%. You better know what you're paying those fees for. So variable annuities, it's going to have market-based growth, right? So your cash value will grow based on that stock market minus those fees, but your income benefit will grow based on that stock market with some fancy bells and whistles guaranteeing some growth to it, okay? Whereas the fixed version is much simpler. The fixed version, you'll have some growth in your cash value without risk of loss, except they will be pulling typically a fee out of your cash value. And then your income benefit will have all those fancy bells and whistles, the big bonuses, the guaranteed growth. When you hear it on the radio, when you see it in the dinner seminars, it's the 7% guaranteed growth, 10%. I've even seen 15%. There are bonuses of 30% out there. So just understand those fancy bells and whistles. That's typically going to be those fixed deferred income annuities. But those two are basically the same animal. The only difference is one's in the stock market and one isn't. Okay, so now let's look at this. So this newer product, it's just really updated its interest rates and payout rates, because that's really what we care about in this case. This newer product that simplifies this whole sales spiel world that I'm not a fan of, made it much similar to Social Security. Social Security, each year you wait from 62 to 70, grows 8%. The actual payment, not some fictitious lump sum amount that isn't real. That's the dinner seminar stuff. No, this is your actual dollars that you would receive if you waited one more year. That's a payment for life, okay? So in this product, we don't have to wait for anniversaries. It's our birthday. If you issue this product 5 days before your birthday and wait till that birthday 5 days later, you get 9.5% growth to your payment. So the deferral period doesn't have anything to do with fictitious growth of any kind. It's actual growth to your payment that you are going to receive for life. So every year you defer, decide not to take the payment, every year you get older, they're going to agree in contractual guarantees to pay you 9.5% more. That mathematically doubles your income in 8 years. So if you wait for 8 years, if you put money in, wait for 8 years, the payment they're willing to pay you will be doubled. Now, There's no fictitious funny money, dinner, seminar, sales spiel accounts. You deposit money into the account, okay? They tell you how much they're willing to pay you day one, and then each birthday you wait, it grows 9.5%. That's that simple. Okay, your real money will grow a little bit in there. Don't expect to knock it off the planet with great growth in there, but the real money will grow, and whatever cash value is left goes to your heirs. Okay, so you put money in here instead of an immediate annuity where the money's gone, or annuitizing the money's gone. It's the insurance company's money. All they're doing is handing you back one payment at a time your money. And then if you prematurely pass away, then they give all that extra money to your heirs. Okay, and the great thing about this, for people that are trying to figure out how to help pay for long-term care, they will double this if you have 2 of the 6 activities of daily living that you need help with. So they don't care if you're in a facility. You can do this at home as long as a doctor signs off that you need help with 2 of the 6 activities a daily reasonably permanently into the future. They will double the payment to you for 5 years and then go back to that single payment. So great deal there. That's going to help out a lot of people in long-term care. So let's take a look at these payout rates, because this is what makes this interesting. We're actually going to be able to lock in these higher interest rates that we haven't seen for 20 years, right? We've got to make sure that we take advantage of this. So the first idea of how to use something like this properly, thinking about how we utilized CDs and bonds, especially when my great aunt retired in the 90s, we just ladder CDs and she'd live off the interest, because inherently people are scared to spend their principal. And I get it. It is scary to spend principal. Okay, but if you don't really have heirs that you care to leave as much money as possible to, you leave whatever's left over, then this will give you a much higher payout rate than any interest-bearing product out there. CDs are paying 4 or 5% interest, bonds, depending on the risk parameters, 4 to 6% interest. We've got to make sure that we understand that this payout rate is guaranteed for life. If you're 55 years old, it starts at 5.6%. And then if you defer, every year you defer, look at 79, it's 80 or 8%. Guaranteed payment to you of 8% of that money every single year for the rest of your life. But if you defer, it grows 9.5% every single year, right? So we could utilize this as a part of an income portfolio. Please don't throw all your money in something like this. You could, if you're trying to build an income portfolio to just receive the yield and live off the yield, certainly using some of this CD money, some of this bond money, and something like this, effectively locking in these higher interest rates for the rest of your life. The problem with buying a 5% CD is next year you got to go find something else. And what if interest rates are 0 again, right? If you really look at economics and how economics work, and you look at our economy, it's going to be very hard to raise and raise and raise and raise interest rates unlimited. We've only raised it a little bit. If you look historically, we've only barely raised it, and we had a few banks go out of business. We got to make sure that we understand it's very hard to raise interest rates. It's very easy to lower interest rates. So this, if you're building an income portfolio, effectively locks in the payout rate. Think about that. You're retired, say 65 years old, you're getting a guaranteed payout rate of 6.6% on the principal of the money that you put in there. You want to wait till your next birthday, even if it's 2 days from now, 7.23%. Don't wait to get this. It's amazing. This helps a lot of people. So maybe you're 60 and you want to use the money at 65. Well, at 60, you start at 6.1%. In 5 years, it's 9.6 payout rate. That's fantastic. And this then guarantees that payout rate for the rest of your life. So think about that as an income producer. The next thing I want to talk about is paying base living expenses. And honestly, this is the only way I've ever talked about these income annuities. Everybody should go into retirement with their base necessity retirement bills paid by guaranteed income. This will make a huge difference in your retirement, in your ability to be comfortable. People that go into retirement with no income, people retiring in their 50s, they are always living scared. It's so hard to spend their savings, no matter how much savings they have. So relying on your savings to pay base living expenses can be extremely scary. So raise your base living expense your base living income, your guaranteed income, and lower those expenses. That's why we want people to have their house paid off when they go into retirement. We want your expenses as minimal as possible and have that guaranteed income be enough to pay those base living expenses. So in this scenario, married couple, 58 years old. Now understand, they're always going to, if it's joint, they're always going to look at the youngest person's age. They don't care if it's male or female, even though females live way longer than men do. In this example, you deposit $200,000 at 58 years old. The guaranteed payout rate is 5.34%. But then it's carried out 9.5% growth each year. You go to retire fully at 67. That's a 12% guaranteed in the contract payout rate. And that's $2,000 a month, $4,000 if you go into long-term care, and that'll pay as long as one of the two of you is alive. That ends up being a pretty darn good deal. And then the other way to use this, what about paying for long-term care? This is where this actually starts making sense to utilize this for people that are up there in age. I've never been a fan of selling dinner seminar, deferred income annuities to people that are over 70. Well, now there might be a reason. So 79 years old, 8% payout rate, $200,000 deposited. Day one, you could trigger it and make $333 a month, theoretically. But what if this is just that break class here, CD money? I met a lot of people that just had little stock portfolios stocked away. I'm not touching it. I'm only using it if I need it for long-term care. If you have that money you're hiding away just in case you need it for long-term care, might as well leverage it up so you get more out of it. If you just need a boost to your income, maybe you got $4,000 a month between Social Security and pension, and you just need a boost to your income to help you pay for long-term care. Look at this, 79 years old, 9.5% income increase every single year. So 8% on up to 19.83%. You go into long-term care at 89 years old, it's a guaranteed payment to you for $3,304 a month. And if you need help with 2 of the 6 activities of daily living, they will double it to $6,600 a month for up to 5 years. Okay, so a lot of uses for this. It effectively locks in these higher interest rates. If you're a believer that interest rates, might go a little bit higher, but any large amounts higher, it's hard to believe. It's very difficult to believe seeing that going forward. So the other thing that I thought was fun and actually really surprised me was required distributions. So if you're 73 years old and you have to take your required distribution, they start right around 3.6%. So $200,000, and I have fictitious growth of 6% every single year. This is just fantasy land, right? 6% guaranteed growth every year blows away the stock market in required distributions. By the way, there's very few little chunks of the stock market that are ever going to outperform that, because volatility when you're withdrawing is terrible. So understand this 6% fixed growth is better, and you can model it all you want. You want to model it against the S&P 500 or anything else, go for it. 6% with the required distribution coming out is going to beat it in any reasonable period of time. So I created fictitious land that's not really possible. Yeah, we saw 6% fixed rates, but can you guarantee 6% forever? No, there's nothing out there guaranteeing that. So here you go, 200,000, 6% growth, required distribution coming out. And what you see here is Required distribution starts at $7,299 at 73 years old and grows to $19,000 by the time you're 100. The accumulation of all the money that you took out of this IRA is $402,000. So hopefully you see the highlighted 402. That's how much this IRA portfolio produced. It was $200,000 growing at 6% and just taking out what the IRS forced us to. Okay. Well, what if we did this? And again, I'm not saying don't go throw all your IRA money in here, but if you're not really concerned about how much your heirs get, because admittingly there's still 130,000 left in this IRA at 100 years old. Okay. Now let's use this income annuity. The guaranteed lifetime payout day one, not waiting for one birthday, day one for a 73-year-old is 7.4%. $200,000 times 7.4% is $14,800, and that payment to you is guaranteed for the rest of your life. Add up 14.8 from 73 to 100, that's $414,000 in your pocket. And if you pass away before receiving all your money, it goes to your heirs. So here's the thing. A lot of people, they look at their retirement and say my 60s and 70s are the fun, spend years because I'm going to slow down in my 80s. Well, look, you don't have to wait till 73. You can do it at 70. You can do it at 65. But the reality is, look at these numbers. You're getting 14,000 as opposed to 7,000. You're getting more money early, guaranteeing that payment for the rest of your life. This will help you spend some of that money and enjoy more of it earlier, right? And that can be quite appealing in a lot of situations when we look at people's retirement. They want to find a way to safely spend more in their 60s and 70s, knowing that they're going to pull back their expenses in their 80s and 90s unless long-term care happens. And oh, by the way, if you need help with 2 of the 6 activities of daily living, yeah, that's right, that 14,000 does double and sure helps pay those bills. So fun ideas. Again, don't go through all your money in this stuff. It's about balance. Have enough income to go enjoy your retirement. Have enough savings to handle the bigger, more emergency type expenses, car, air conditioner, that type of stuff. So you got to have some balance, but this is sure a fun tool to utilize in a lot of different situations. And I'm really happy that they've kind of cleaned this up. They basically just put a chart with ages on there. And if you are this age, the initial payout rate is this, and it grows 9.5% each year you decide to wait. Nothing wrong with that. All right. Hopefully this helps. Fun little product that I wanted to bring to light because I've typically talked bad about most of these income annuities out there. I constantly have people coming in saying, look at all this that I have. What do we do with it? And they've got an income annuity and didn't even know they had an income annuity and had no plan to use the income annuity. So we got to rearrange everything, trying to make the best of it. Now I'm actually looking at that going, well, in some fun cases, this might actually enhance somebody's retirement and help you enjoy it and help you spend some of this money, which honestly, I find as one of the biggest problems out there. People have lots of money, but they don't actually feel comfortable enough to spend it. So that's why I'm more of a counselor than anything else. All right. I hope you enjoyed this a little bit and saw some fun ways to utilize it. Certainly give us a call, shoot us an email. We're licensed in virtually every state, so always happy to help. If you have any questions or anything, shoot us an email, comment below. Always happy to answer them. Thank you. See you next week.